Hey friends, today I'm going to tell you about two Schwab ETFs that outperform Vanguard ETFs in every category with less volatility. These two ETFs give you a basket of dividend and growth stocks, and they could help you become a millionaire and hit that early retirement goal. So let's get into it. The two funds I'm talking about are SCHD, the Schwab Dividend ETF, and SCHG, the Schwab Large Cap Growth ETF. And the two Vanguard funds we're comparing them to are VIG, the Vanguard Dividend Appreciation ETF, and VUG, the Vanguard Growth ETF. And you're going to be amazed that these Schwab funds have outperformed both those Vanguard funds with less volatility. First thing we've got to cover for those dividend lovers out there is the dividends, right? And this is more applicable to SCHD and VIG. SCHD currently pays a trailing 12-month yield of 3.53%. That's a nice yield compared to VIG of only 2.03%. When we look at dividend growth, the 3-year growth rate for SCHD is 14.2% and VIG is only 10.8%. When we go to 5 years, same thing, SCHD outperforms 12% versus 8%. Now, SCHD and VUG, the two growth funds, we're not looking for dividend yield from those, but they do pay a small dividend yield, 0.58% and 0.69. That's not really something to focus on when you're looking at growth stocks. And here we go. We're just looking at overall performance right now. I'm about to show you a full report that goes through all the holdings and the risks associated with each of these funds. But right now, we're just looking at the overall performance, and you can see that year to date, SCHD is actually down less than VIG. And what's crazy is that VIG is actually more conservative, right? It's got a lower dividend yield. It grows slower. The dividend grows slower. And so you would think for a more conservative fund, it would actually be down less. But year to date, it's down 17.5%, and SCHD is only down 13%. Then if we look at the 10-year performance, SCHD is up 142.9%, and VIG is only up 137.88%. So right now, at this point in time, SCHD is outperforming VIG over both the short term, which is year to date, and the long term, 10 years, 142 to 137. If we look at 3 years, SCHD is outperforming. If we look at 5 years, it is close, but it's within a percent basically, where SCHD is up about 44.6% and VIG is up 45.6%. Let's jump over to these growth funds, right? And year to date, SCHG is down 29.71%. So that's a huge drop right there. But VUG is down 31.48%. Then if we get to 3, 5, and 10 years, SCHG really shines, up 34.8%, 70.8%, and 236% versus 30%, 62, and 209. So in every category, SCHG is the better option for performance than VUG. This is a comparison of SCHD versus VIG. Let's talk about drawdowns. When you own an investment, the thing that can scare you out of it is drawdowns, right? How much is this thing gonna drop? And that is a big risk for people, right? Sometimes people don't like that type of volatility. Now, things are going to be different in the future, so this doesn't mean that, this is what's going to happen in the future, but this is what history shows us. The most that SCHD has gone down over the last year is 16% versus VIG 20%. Over the last 3 years, the most it's gone down is 33% versus VIG 31%. Same thing over 5 years and then over 10 years. So it has had a slightly larger drawdown over the past 3 years and 5 years, that 33% versus 31%, but still, that's really not a huge difference there, only 1 to 2%. And now we're going to take a look at the top 10 holdings of SCHD versus the top 10 holdings of VIG, and it's for you to decide which one you like better and which one fits your investment style better. For SCHD, it's Merck, which is a 4.5% position. Amgen is the next one, 4.2%. IBM, then Pepsi, Pfizer, Lockheed Martin, Texas Instruments, Cisco Systems, the Home Depot, and Coca-Cola. In VIG, we've got United Health, Johnson & Johnson, Microsoft, JPM, Procter & Gamble, the Home Depot, Visa, MasterCard, Pepsi, and Coke. And so if you notice, they do have some of the same holdings. We've got Home Depot, we've got Pepsi, we've got Coke, that are in the top 10 for each of these. But then in VIG, what's crazy is the top 3 are UNH, J&J, and Microsoft versus the top 3 of Merck, Amgen, and IBM. Let's jump into SCHG versus VUG. And what I'm going to show you after this is what happens if you combine 50% in SCHD and 50% in SCHG. And we did a comparison to VU, the famous Vanguard index that everybody loves. These are the growth ETFs, so we would expect them to be more volatile, and oh boy, they were. So this is compared to the S&P 500, essentially compared to VOO. Minus 29% year to date for SCHG and minus 31% to date for VUG, the Vanguard Growth ETF. Then if we get to 3 years, SCHG starts to outperform. It's up 11% versus Vanguard up 9%. Over 5 years, 12% versus 11%. And over 10 years, 14% versus 13%. All right, and here we go, comparing the top 10 holdings in SCHG to the top 10 holdings in Vanguard Growth or VUG. And so a lot of them are the same. You've got Apple and Apple, number 1 and number 1. Microsoft, Amazon, Google, then Tesla, and then Tesla for SCHG, and Google's the next spot. United Health versus Meta and VUG, Nvidia's over in VUG as well. Then you get Visa. Visa is the 10th position. So some very similar positions here. And what the difference is the weighting. Apple's a 14% position in SCHG versus 13% in VUG. The only other, real major difference in the top 10 is Tesla's a 4.46% position versus Google being 3.85. But if you add up Google and Goog, then they're almost 7% together, which makes it pretty much the top 3 largest position in both portfolios. And so now let's cover real quick just the process for these funds and why SCHG is different than VUG. So this is from Morningstar. This index pulls constituents from the Dow Jones US Large Cap Total Stock Market Index, which is about 750 of the largest US companies. They each receive a style score based on 6 metrics: projected price to earnings ratio, projected earnings growth, price to book ratio, dividend yield, trailing revenue growth, and trailing earnings growth. Depending on their score, stocks land in either this index or its value counterpart until each holds half of the total market cap. Unlike most other style indexes, each stock is fully allocated to either the value or growth index. And so this is really interesting. They've actually got a value fund, which I'll cover in a different video, that they use as almost like a counterweight to this index. Okay, and again, this gets a 4-star silver rating from Morningstar. Jumping over to SCHD, the dividend fund, it gets a 5-star silver rating, and the process is a little bit different, right? So the fund's focus is on yield and fundamentals, which results in a portfolio of financially stable firms that are poised to maintain their dividend policies. And so basically, it's going to own stocks that are in the Dow Dividend 100 Index, which covers a broad base of US stock but excludes REITs. Then the index filters out stocks that fall short of liquidity requirements. So if a stock has a market cap smaller than 500 million, it will not be in this fund. If it has not paid dividends for at least 10 consecutive years, it will not be in this fund. And then it ranks stocks that meet those criteria by indicated annual dividend yield and screens out those that rank in the bottom half. So it's only taking the top half of everything that comes back from those screen. Then it gives everything a composite score that looks at 4 metrics: cash flow to total debt, return on equity, yield, and 5-year dividend growth rate. It also controls risks and volatility by capping each stock's weight at 4% and each sector weight at 25%. What you'll find is VIG is actually pretty similar. So Vanguard Dividend Appreciation strict criteria produce a high quality portfolio with a competitive risk profile. They also introduce concentration risk in sector bets that may or may not be adequately compensated, warranting a process rating of above average. So the fund tracks the S&P US Dividend Growers Index, which holds stocks with a history of increasing dividends for at least 10 years. Securities must pass minimum market cap and trading volume requirements to be eligible for inclusion. Index ranks eligible stocks by their indicated annual yield, then filters out the highest ranking quartile to avoid riskier bets but it lowers the threshold for current holdings to the top 15% to limit turnover. Selected stocks are weighted by their float-adjusted market cap, subject to a 4% threshold on individual positions. It also spreads its reconstitution over a 3-day period to mitigate market impacts because it's a large fund. And so if you'll notice, it actually doesn't have the same type of criteria that SCHD, and I actually prefer SCHD's screening criteria that they use to make sure cash flow is good and all of that, and dividend growth, instead of just kind of a market-based approach, which is what this uses. The cool thing about ETFs is you can mix and match them. So what if you went 50% SCHD and 50% SCHG? That's the comparison I have right here, and we are comparing it to VOO, V-O-O. And I think the results are going to be surprising. And so up top is essentially 50-50 SCHD and SCHG versus VOO, and the benchmark's going to be basically the same as VOO because it's the S&P 500. So year to date, the 50-50 mix is down 20%. Over the last year, down 17%. But over the last 3 years, up 12% on average. Over the last 5 years, up 12% on average. And up over the last 10 years, up 13.5% on average, which outperforms VOO in 3, 5, and 10 years by 1% to 2%, which can be a lot over a long period of time. All right, so now let's look at the top 10 holdings. This would be top 10 combined if you own 50% SCHD and 50% SCHG versus if you own the S&P 500 or VOO. So you get Apple, Microsoft, Amazon, Broadcom, Merck, Amgen, IBM, Pepsi, Pfizer, and Lockheed Martin versus Apple, Microsoft, and Amazon. They're the same right there with about the same concentration. But then in the S&P 500, you get Tesla, Google, Berkshire, United Health, J&J, and ExxonMobil. And finally, you can see that this mix of 50-50 SCHD and SCHG yields 2.07% versus the S&P 500 or VOO at 1.69%. So a little bit higher dividend yield, and that dividend growth rate is going to be a little bit higher as well. And so what you have is two different strategies. The 50-50 Schwab fund strategy might surprise you in how much it outperforms all of its Vanguard counterparts and the S&P 500, and it owns, a top 10 position in stocks that you might not expect, like IBM, Pepsi, Pfizer, but it's a little bit different than what you get just being exposed to the S&P 500. If you like its process and its strategy, it might be worth considering. And so how long would it take you, starting at $10,000, to become a millionaire invested in this fund or any fund really? And here's the key. What you need is more time or investing more money. Don't change your expectations for rate of return based on your types of investments, because that's what's going to get you in trouble. We've got to go off of the market averages and then understand, is what we're doing, does that tend to outperform the market or underperform based on history? And that's not an indication of exactly what's going to happen in the future. But then is it more volatile or more risky? Are we taking on extra risk to try to get extra return? Starting at $10,000 with 30 years and an 8% return, which is about what the S&P 500 has done over the last 100 years, putting in $500 per month, in 30 years, you would have $809,000. So what's the true secret to becoming a millionaire in stocks over the long term? It is increasing your income and contributions, saving more money, and then investing over the long term and doing it every single month. That's the secret to investing. Anybody that tells you different is trying to sell you something or lying to you. So if you could do $1,000 a month over 30 years, then you end up with $1.5 million if you can average 8% a year, and you're starting at $10,000.